This, we are now joined by Karan Taurani of Elara Capital. Karan, good morning. Thank you so much for joining us. Well, tell us, what is your estimate? What would the EBITDA impact be considering the annual orders by Zomato because of this hike?
Hi, good morning. So I think, considering this impact, this definitely is a very big lever for the overall EBITDA margins. We believe that there could be an absolute EBITDA rate of about 7 to 8%. The increase in take rates will be in the range of 25 to 30 bips. And Zomato has seen a consistent increase in their take rates over the last 3 quarters, I think, since the time, platform fee has been introduced.
Okay. And past hikes in platform fees suggest that there is no impact on demand, right?
Yes, absolutely. So, Reema, if you look at the situation here, what happened clearly is that, the loyalty programs right now are offering free delivery, right? And some delivery charges, have become zero for the loyalty customers. But, if you look at the AOV, which is about 400 rupees on an average, the platform fee is getting hiked by, 1 rupee. So even if we say that the platform fee goes up to 6 rupees, 7 rupees, or even 10 rupees, the potential impact is not going to be very big. It's not about 2.5% of AOV. Even if it goes to 10 rupees, in the higher end, upper end over the next 2 to 3 quarters. So I think it's happening in a phased manner. The customers are not feeling the pinch at one point of time. And I think that is the good part, in terms of getting the correct blend for profitability for Zomato.
Considering the delivery fee for some of the distances goes as high as 50 rupees as well. So I think a 10 rupee convenience charge or the platform fee is something that at least the gold members wouldn't mind paying as well. But Karan,
it's just that, it's happened fairly quickly because I think it was only in April that it was hiked from 4 to 5 rupees. Yeah. And then again, 3 months later, it's hiked from, 5 to 6 rupees.
But so Karan, your take here, is there an expectation of a further a hike in this platform fee, and is this something that investors should pencil in as well if they're looking at the stock?
Yes, definitely. So I think this started off last year in the month of August with 2 rupees, went up to 5 rupees in Jan, and then in April, and right now, it's coming to 6 rupees as well. So the point is that this is a good manner to kind of see offtake, and they are doing it very selectively. They aren't doing it in a blanket manner. They are trying to do it in top 4, top 8 cities, see the response on demand, and then move to other cities. So doing it in a blanket manner may have a negative impact, in terms of the customer demand or in terms of price sensitivity in the markets, which are tier 2 and tier 3 markets where AOV is very low and the percentage, could be higher in terms of the platform fee. So doing it in a phased manner is the correct way to do it. And I think going ahead, you will see further increase in terms of platform fee going ahead as well. And we believe this is a lever for margin improvement, because if you look at restaurant commission rates, we believe they have somewhere plateaued out. Advertising revenue and platform fee are the bigger levers for margin improvement. And we have already penciled this into our estimates, in terms of potential EBITDA margin improvement. Their adjusted EBITDA as a percentage of GOV is about 3.3% today, as on Q4 that is. But going ahead, potentially there is a potential for this to move to about 4.5% over the next 2.5 years. So, this is a lever. It is penciled into our estimates. There's no such big delta which is going to be created. There's no such big upgrade which could happen. This is largely factored into our estimates.
Okay. Just quickly give us the key numbers in terms of FY25. What could be the potential revenue? What's the potential revenue growth? With this, what would the EBITDA margins now stand at on an adjusted basis? And even on the bottom line, what is your own expectation?
So I think in terms of potential growth for the food business, on GOV, we're expecting a growth of about 20%, 18 to 20%. In terms of revenue, we are expecting revenue growth rates to be much higher versus 20% because of increase in take rates. So if you look at take rates currently, they stand to be about 20.6 to 20.7% roughly. I think you will see an improvement of about 60-70 bips in terms of take rates because of levers around advertising and platform fee. And in terms of EBITDA, as indicated, Q4, the exit was about 3.3% adjusted EBITDA as a percentage of GOV. Potentially, we believe that could also move up towards 3.6, 3.7. And I think over the medium term, we'll find that in the management guided range of about 4 to 5%. So potentially, even adjusted EBITDA could move towards 4 to 4.5%. And I think in terms of valuations, we are assigning it a 55 times, forward EV EBITDA for the food business. And in terms of the target price, we have a target price of 280. And in terms of contribution, we believe that about 40 to 45% of the business would be valued because of the food.
Sorry, you said the adjusted EBITDA this year would be?
Adjusted EBITDA this year, in terms of percentages, would be around 3.6, 3.7% of GOV.
Okay. And when do they get to their target? I think their target was 4 to 5%. So this year they hit 3.7%, according to your estimates, post this hike in platform fees. How soon before they get, will that happen in FY26 itself? And what about the ESOP cost? Because that was a drag in the prior quarter. Will that weigh on the margins or overall profitability?
Yeah, right. So in terms of margins, I think the guided range is about 4 to 5%. And, post that, they'll be reinvesting the money in terms of within the business, probably, even look at the take rates might even come down to a certain extent. That could also happen because they did indicate of, sharing some kind of, benefit with the restaurant partners as well. But that's a very medium-term thing. So I think, in terms of the margins, as I said, adjusted EBITDA will move towards 4.5, 4.6%. By F26 as per our estimates. Secondly, in terms of ESOP cost, I think our margin estimates are clearly after the ESOP cost. So we have already factored in the negative impact of ESOP cost as well, which could be in the range of 40 to 60 bips on annualized basis.
All right, Karan, thank you so much for joining us with your take on Zomato. With that, we'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.